Hello, everyone, and welcome. We're going to give everyone a moment or two to sort of get into the swing and get into the room here with us. While we do that, I'm going to start a little bit of introduction and complete our land acknowledgement. So my name is Linda Griffian. I'm the Education Programs Coordinator with BusinessLink, and I want to thank you for joining our webinar today. We are honored to provide services to all entrepreneurs and specialty services to our immigrant and Indigenous entrepreneurs. We are inclusive in our cultural understanding and awareness of the histories of our country. With that, we will start this event with a land acknowledgement to recognize all of Alberta. We want to acknowledge that in the province of Alberta, we are situated on the traditional territories of Treaties 4, 6, 7, 8, and 10, ancestral homeland of diverse First Nations groups, Métis and Indigenous people whose ancestors have walked this land since time immemorial and whose histories, languages, and cultures continue to influence our vibrant community. We pay respects to the Indigenous people of this land, past, present, and future, while recognizing their cultural heritage, beliefs, and relationship to the land on which we reside. Thank you for joining us for our webinar today. Vanessa Brown will be presenting to us on advanced financial statements. If you would like to ask a question during the webinar, please click on the Q&A box in the meeting controls and type a message into the question box. You're also welcome to introduce yourselves in the chat box. So you can say hello, your name, your business, how long you've been in business. If you'd like to do that in chat, I'll make sure I have those controls turned on for you in about a minute and a half. A reminder that this information is being provided for general knowledge and should not be taken as professional advice. It's my pleasure to welcome Vanessa today. Please go ahead and introduce yourself, Vanessa, and feel free to get started.
Hi, my name is Vanessa Brown. I've been an accountant. I've been working in accounting since 1995, and I obtained my first designation as a CMA, a Certified Management Accountant, back in 2003. I obtained my second designation as a CA, Chartered Accountant, in 2007, and those were all merged into one governing body of the CPA, the Chartered Professional Accountant, in 2014. My training and experience is both in management accounting and in financial statement reporting, the more technical side. I currently work with small business owners and have for the last 12 years, small businesses here in Alberta, and I assist mostly with the accounting and tax, and also some business advisory services. I was hoping that you might all be able to, in the chat, tell me a little bit about yourself, what city you're in, what business organization you're with, your role, and whether you work with, and this is a lot, I'm going to ask for 5 things. The business structure that you have, whether it's a corporation, a partnership, or a sole proprietorship. And I'm putting this into the chat as well so that you can follow along. And what you hope to get out of this session. So I've just put that into the chat. That will just help me tailor any of the specific items to something that might be a bit more useful to you. And yes, please feel free to ask questions throughout, because I'd rather deal with them while we're on that topic to go through those. So we have about an hour, so we'll go, well, about 55 minutes from now. And so it'll, anticipating at least 50 minutes for the material. And then whatever questions what questions you might have. So the session today is advanced financial statements. And we're here to discuss 8 questions that a lot of business owners might have about their financial statements. The questions are how are cash and accrual accounting different? Why my balance sheet is so complicated. And I think that's even a bigger question for small business owners. I think the bigger question is, why does my balance sheet even matter? And how does it affect my profit and loss? because it's very common in my practice for business owners to not understand why the balance sheet has to be right and how it can affect the profit and loss. So hopefully I can shed some light on that. Another question is, what is depreciation or amortization of my assets? Why do I even do it? What's the significance of it? Fourth question, why are prepaid expenses assets? The fourth question, how do I account for intangible assets? And some of you may even have the question of what is an intangible asset? So we'll cover that. Question 6, what are retained earnings? And the seventh question, how are earnings per share determined? And the last one, what is non-operating income? And that's particularly important when we try and take the income statement and make it into some pro forma, well, just a cash flow statement and then a pro forma cash flow forecast. So the first area we want to talk about is cash accounting versus accrual accounting. So cash accounting with the small business owners is often more how a bookkeeper would maybe approach bookkeeping, taking information from the bank statement and summarizing it into the books and records of the company. In that, there's no consideration for things that have been received but not yet paid. So if you think about inventory, you may have received inventory, but not yet paid for it, and yet it's on the shelves. And so it's not yet showing anywhere in the books. That's what happens when we just do things with cash, is they go through the bank. Cash accounting and accrual accounting can be very similar for a retail business that doesn't really keep inventory, or for a service organization, say consultant that gets paid at the end of each month. But most businesses have some need for some kind of an accrual if you're going to get an analysis of your actual business results. So with accrual accounting, we account for the activities as they take place. So if goods were received for inventory on March the 15th, and the business doesn't pay for them until April 15th, we would still record that inventory purchase as an accounts payable item under accrual accounting, so that it's in our system right on March 15th, even though we don't make the payment until April 15th. And many of the complexities that happen in financial statement reporting has everything to do with just the timing of the event. And a difference between the timing of a service being delivered or goods being delivered and when it is actually paid. So here is a basic balance sheet. I see that several of you are business owners, and so you would be somewhat familiar with the balance sheet, at least a basic one. So we have cash, inventory, accounts receivable. So there is some element of accrual here with accounts receivable. We are recording inventory. Perhaps it's periodic inventory, maybe it's perpetual. We have depreciation on the property and equipment. We have accounts payable. So again, accruals for things that have been received, either services that have been received or goods that have been received and not yet paid for. We have the current portion of bank loan payable, which typically is anything due in the next 12 months, and then the long-term accounts payable. Overall, we have total assets being 100,000. We have total liabilities being 60,000. And then we have owner's equity. And just by the terminology owner's equity, this is for a sole proprietorship, not a corporation. We have owner's equity. Well, that said, we've got capital stock. So I've got a little bit of conflicting information there, but it's shareholders' equity, I guess. So assets equals liabilities plus owner's equity. As we go through the presentation, we're going to make this balance sheet a little bit more complex. So what are some things that make the financial statements more complex? Some of you may have, it may have inventory, but you might also be a manufacturing business. And once we get into manufacturing, things definitely get more complex on the balance sheet. We would have raw materials, we would have some work in progress, and some finished goods as well. We would have prepaid expenses, depreciation on assets, and then we might even have some goodwill and other intangibles such as patents and trademarks. On the liability side, we have many types of accrued expenses. We can have accrued payroll, accrued vacation, accrued warranty expense, all kinds of different accruals, depending on what the contractual nature of our business is and what obligations might be coming up for the business. Could have loans payable. And then under owner's equity, we have, if you're a corporation, you would have capital stock, but you'd also have retained earnings. So here's a more complex balance sheet. So we have the raw materials would be items that are just received. And if you're a manufacturing company, now all of these goods that have just been received need to be converted and put together with other products and built into what will finally be a finished goods inventory. In a lot of my experience, I've dealt with real estate development. So what we might see in the raw materials is a bunch of lumber and other building parts. And then there would be this assembly time, which we may call work in progress or progress inventory. And then over time, it gets completed and we finally have a finished goods. In the work in progress, we would be allocating some labor. We would be allocating costs from raw materials into that work in progress. Accounts receivable are for things that we've delivered to people, either goods or services that we've delivered to people that they have not yet paid us for. This can also be a contractual receivable if we've got a subscription business, for example, where we have people pay a monthly subscription, and if they didn't actually make that payment yet, there would be this receivable there too. We have prepaid expenses. We will talk a little bit more about prepaid expenses on a future slide, and same with the depreciation and goodwill. Some additional things here, we've got some accrued expenses. So maybe this is the accounting fee that's related to this year end that doesn't actually get worked on until after, but we accrue it because it relates to this particular year end. With payroll taxes payable, so this would be those withholding taxes that are due to the government on the 15th of the month. For some businesses, that might actually be 5 days after month end. If you're large enough that you have a earlier payment schedule with CRA, but these were incurred in the month end or that year end, but not payable until just after year end. So we want to make sure we've incorporated those so that on the income statement, we can reflect the full cost of earning the revenue in the year. The bank loan payable, we break it out between, again, current and long-term portions, and then we see capital stock and retained earnings. I see that there was a question about retained earnings. We are going to talk in a bit more detail about that on a future slide. Okay, so I started to talk in detail about these. So if you're just a business retailer, you might actually buy all of your goods as finished goods. And so you don't have to distinguish the difference. All of these other work in progress or raw material are for companies that are manufacturers. And again, this work in progress is something that is being worked on that is not yet available for sale or ready, is complete for sale. In the services industry, like myself, when I've been working on a file, I do have work in progress inventory as well. Myself and lawyers and any consultants out there will often have a work in progress. And from a tax perspective, we actually have to record that and include it. So we would say we had a file that was going to bill out for $5,000 and we estimate that we're about 50% complete. We would actually record that as a work in progress inventory at $2,500. Now, and just to be clear, in my example of services in the services business, if I come to my year end and I have, say, 5 files that are all 50% done, and they were all going to bill out at $5,000, again, I would have that $2,500 times 5, and that would be my work in progress. Why is that important? It would be because I've paid staff. I've incurred some of my own time on those files, but I've incurred expenses to, I've supplied office space or software in order to complete those year ends. So all those expenses are showing on the income statement. And so when I reflect that work in progress, the other side of the entry is an adjustment to sales. And so then I'm acknowledging a portion of the sales revenue that will come in after the year end, and it's correlating and matching to the expenses that have been incurred. I see a question there about would work in progress apply for a landscaper too? And yes, it could, especially if you've got a very big project. Some of the landscapers I've worked with will have a massive earth moving, big hills that they're dealing with in somebody's backyard. And it might take 3 months for that work to get done. And if you might do progress billing, but the progress billing may not actually match the amount of work that's been done. It depends on how you've set that contract up. And so you would want to be taking a look at how you've progressed on the total contract and whether or not you've accrued enough for the work in progress inventory. Again, we deal with that on the balance sheet so that our income statement is more accurate and reflects better the actual performance of our business. So prepaid expenses, when I first started as an accountant, prepaid expenses were considered this easy and normal, easy thing. But over time, I've discovered that it's one of the harder things to actually explain to business owners why we adjust for these. When we pay insurance, we might only make one payment in the year. If we have a December year end, we might pay our insurance for the entire year in June. And our insurance bill might be different year over year. And so if we want to get the insurance expense correct on the income statement, we want to reflect on our December financial statements that we've already prepaid 6 months of our insurance for the next year. So making these adjustments, well, easy for someone like myself. Again, this all speaks to the timing. It's all timing that makes accounting more complicated because we make a payment for something at a different time than when we actually use it up or when we deliver things. And so that's why we make all of these adjustments. Rent, most places actually would collect a security deposit and possibly the last month of rent in advance. They would be collecting that 5 years in advance if you've signed for a 5-year lease. So the security deposit would be returnable upon exiting the place in good shape so that they don't have to do repairs and maintenance. And that final month of rent would be applied the last month, 5 years from now. If you've signed a 5-year lease, it would be applied that last time. So all of these things. Office supplies are another one. So maybe you buy a whole bunch of office or advertising supplies. Perhaps you buy, 8,000 business cards. And these days, I know business cards aren't used as much, but it was a common adjustment for us to in businesses to adjust for letterhead and business cards, things that were paid in advance. Particularly important when it's a bigger expense or when it's been incurred, that expense has been incurred right before a year end. And maybe it's a whole year of supplies that were purchased December 15th for a December 31st year. We'd want to acknowledge those as prepaid expenses because it really wasn't an expense to earn the revenue that we just made in that year. It's really an expense that was incurred to generate new business leads in the coming year. So this is why we're basically moving out expenses out of the income statement and putting them onto the balance sheet so that they can be acknowledged to match the future revenue. Okay, so now I will talk a little bit about intangible assets. Intangible assets are things that we might invest in that we can't see. A website, for example, we might spend $10,000 with somebody to get a website up and running, and that typically qualifies as an intangible asset that we would write off over time because that initial cost to get it up and running and to get all the functionality in place and not just to maintain it is more significant, and it will generally last 3 to 5 years without having a major revamp. So we would write that off over its useful life. Other intangibles are trademarks. I've had some companies that invested quite a bit in getting trademarks, especially when you get into the beer industry, beer or wine, getting those trademarks, those special names that are catchy and that people want to, buy your product just for the name. Another one is patents. So we might have a patented process. You might have a patented product, something that patent is to protect it so that it can't just be copied by everybody else, especially when we do something unique. And then there's copyrights for any type of material that is written that is an original work. Goodwill. Goodwill is usually a purchased item. So if you buy a business, it's the part that can't be attributed to anything else. I'm going to back up on that goodwill because in a lot of businesses, you're buying a client list as well. In accounting, in law firms, things like that too. It's a client list. It's that's being acquired. We can usually allocate a large part of the purchase price when you're buying a business to that client list, which is also an intangible. It's not like it is something hard that you can touch, but it has value. The contact lists, the processes and procedures and everything that was acquired. Goodwill is the catch-all for all the other things that generated value for the business that we can't sort of break it out. It's not attributable to a recurring revenue source from one particular client. It's just that overall, group of people that work together, that have worked together for a while. It's all the process and procedures that everybody knows that work. And so it's purchased. We don't ever recognize goodwill as an internally generated item. It's only when a business is purchased. And Generally speaking, goodwill is not amortized, but all of the other ones may be. If anyone's purchased a business, I could go into a bit more detail on that because that's where most of them originate from. One thing I will comment on is that you might pay, like, for example, my website, I paid $10 to acquire the name, and I just pay an annual $10 fee to keep it up. But that name, like, Coca-Cola, for example, everybody knows Coca-Cola. It might have only cost them, $1,000 to make that name and copyright it. But now it would go for millions of dollars just because it's a very recognizable name. And again, we don't recognize that increase in value unless somebody actually acquires it as a third-party transaction. So let's talk a little bit about depreciation on our assets. We depreciate anything that has a limited useful life. And from an accounting perspective, we want to amortize it over the useful life of that asset. So we have two main estimates to make. When we bought that piece of equipment, let's just use a piece of equipment as an example. We need to estimate how much we're going to use it each year, and how long we think that piece of equipment will last with that use. So if it is a vehicle and we are driving it for work 50,000 kilometers a year, and we know that a lot of vehicles will last about 300,000, that gives us about a 6-year useful life. And that's generally how we want to amortize things for financial statement purposes, is amortize it in accordance to how we actually use it. We determine the policy upfront, so it's based on estimates. Later, however, if we determine, we thought we were going to use that vehicle 50,000 kilometers a year, but we're actually using it 75,000 kilometers a year, we can make an accounting policy change partway through. It has to be justified, it has to be explained, and we have to have some concrete evidence about it. So some odometer readings, things like that, but we can make an accounting policy change. This is different than tax. And I would say that with small business owners, you are generally just getting a tax applied amortization rate on your financial statements. So based on, what tax rules are. So for that same vehicle, you would get an amortization rate of 30% per year on a declining balance, meaning meaning whatever is left in the net asset pool, we take 30% of it. So in year one, maybe we paid 100,000 for the vehicle, and the tax rate of 30% is applied, but it's the first year, so you get a half-year rule. This is what most of you would be experiencing. From an accounting perspective, we really want to estimate how we will use that piece of equipment and then actually amortize according to that. Again, why would we want to do that? It's because an asset is a big financial expenditure. We want to match the cost of using that asset the best way possible to the income that we generate, to the sales revenue. So the better we are at estimating for accounting purposes, the better our income statement reflects our actual cost, and then we can estimate better our future cash flows. When am I going to need to replace that piece of equipment? I better be, saving up some money in the bank for that. I've got this big capital expenditure in 3 years from now. I better not spend all the money in the business and keep it there ready to buy that, or be prepared to take out a loan and pay interest. I see a question about capital cost allowance. Capital cost allowance is the tax term for amortization. It's the very specific rule used in the Tax Act, which does not reflect the actual use of the asset. It is just a statute rule, so that we had a standard way of amortizing the same type of asset for all businesses when we apply tax rates. Tax and accounting do not need to be the same, but because a lot of business owners may not understand fully what amortization is, or maybe estimating their cash flow needs in other ways, time often isn't taken to do an accounting amortization, and a tax rate is just applied. But you can always ask for that as a client, I'm just saying. I modify based on what my clients need. So further to this depreciation, we've got a $50,000 dump truck. We know we're going to use it for 5 years. We know we're going to use it the same amount each year. So this is really important, because this means that we're taking this dump truck, we're using it on construction sites only in the summer for May till September. That's it. We're not going to be driving it, super crazy in 1 year and then not so much in the next year. It's the same each year. We would just depreciate it straight line, $10,000 per year. And again, why would we do that? Because we are driving this $50,000 dump truck to earn revenue. When we're earning that revenue, we want to be expensing a little bit of this truck along the way to match against those revenues to reflect the actual cost of doing business. Because if we didn't amortize it, if we just expensed it all in 1 year, for example, we just, we made $300,000 of revenue and we expensed $50,000 dump truck all in 1 year. Then the next year we still have the dump truck around and we make the same $300,000 of revenue and we have no $50,000 expense. It would be weird. We'd be asking, like, how did we get so profitable? So that's the intent. It's to understand, to match those expenses to the revenue. Okay, so on to the liability side. So I talked a little bit about accrued expenses and payroll taxes payable before. Let's talk about a few others. In the accrued expenses, we would have other things like GST that's payable. So with a lot of small business owners, the GST is due annually. So if you're $1 million in sales, or I should say just under, if you're $999,999 or less of sales in a year, your GST is only due once a year, 3 months after your year end. You're collecting it from your customers all throughout the year. It's trust money. You've collected it from your customers in trust for the government, and you owe it to, you need to pay that to the government. So you need to show that as an accrued expense. And in this case, it's not really even accrued expense. It's an accrued payable, because you've collected the money along with the sale. And when you've collected it, you've put it in here as payable to the government, to say, I've collected this for you, government, and now I'm going to have to pay that money out. It's so that you can see that I've got 10,000 in the bank and I owe 9,000 in GST. So I better not spend any more money out of the bank until I've paid that obligation to the government. Your income taxes payable, again, they're not due until 3 months, maybe 2 months, but usually 3 months after year end. And we want to make sure we've reflected that as an amount owing to compare to the cash in the bank, and also to reflect on the income statement as an expense of the business. Accrued wages, and accrued wages isn't just the wages earned by the employees, but it's the vacation time. So we want to make sure we've accrued vacation for anybody who has earned it but has not yet taken it, so that we are, as people are working, we are realizing their entire payroll cost, because the hourly wage is just one component. There's the CPP and EI component, and then the vacation. If you give them 3 weeks vacation, we want to be acknowledging the cost of that 3 weeks of vacation throughout the year in our total all-in cost of our staff, so that when we see our revenue and compare it to expenses, we can get a better picture of how much our cost really was and to earn that revenue. Another accrued liability, I'll call it, it's not really an expense, it's an accrued liability, is unearned revenue. So in a lot of businesses, somebody might take a 10% deposit before the work is even done, before it even starts, because you need certainty to plan the project, or and certainty that the customer is committed. So if you've received 10% and you have not yet done any work on it, it's unearned revenue. In the construction industry, with building developers and that, the statute even allows them to take 10% up front. And so they'll hold that in the unearned revenue. And then as they're doing work on the project, they'll have work in progress as an asset that's offsetting. So as they do the work in progress, the other side of the entry that creates that asset is revenue. And then eventually they'll invoice for the final product, and then also acknowledge this other 10% down payment as unearned revenue. This is all, again, timing and matching. And so if we can always think in terms of, have I earned that money yet? Have I actually used up that expense yet? Have I incurred an expense that I have not yet paid? These are all the questions that go into these accrual entries. Okay, so bank loans. Some of you might have bank loans, and you may not know why we break this loan payable out into a current and a long-term portion. The current portion is always the amount that's due with, well, I won't even say that. It is almost always what the amount that's due within 1 year. I used to do some work with golf courses. And one particular was getting, we had a 3-year development timeline. And so the current portion was actually the next 3 years of payments, because that was more the operating cycle we were dealing with. It's a little bit unusual, but because most businesses, the operating cycle is the 1 year, but occasionally we might have an operating cycle that is 18 months or 2 years. Developers would also have an 18-month or 2-year protocol. If they're, say, doing a residential complex, they might take 1 year for each one, more like 18 months for each complex, and then we might actually put the current portion as 18 months. Most of you, probably all of you, it's the current portion is just going to be the amount that's due within the next year, the next operating cycle, the next financial statement cycle, which is 1 year. The long-term portion is anything that's due 2 years and more in the future. So in this example, the $5,000 sitting in the current portion, that amount will be due, and that's the principal portion over the next year. There'll be an interest component as well. So the actual payments to the bank might be $7,000 in total, but the $2,000 of interest would be expensed with each payment to the income statement. And then at the year end, we would figure out now again what the new principal that will be due in the next year, according to the amortization schedule with the bank, and do an adjusting journal entry to put that current portion there. This could also be a rolling amount, so that if you are doing monthly statements, you can actually continually adjust it so that it's the next year always being populated there. Some of the bigger companies do that so that the cash flow projections, that a lot of it's programmed from their financial statements, they'll be able to get a better accurate picture on there. Okay, so this will answer somebody's question in there. I've never understood retained earnings. And it's actually pretty simple. The name says what it is. It's earnings that are retained in the business. Okay, so this is the accumulation of the net income of the business since the beginning of time. So if the company has made consistently $10,000 a year and never distributed a dividend, and if you're a sole proprietorship, just, there was no maybe withdrawal or distribution to the owners. That $10,000 a year for 10 years would now be $100,000 of earnings retained in the business. Okay. This slide does point out an important part, is that just because we have retained earnings does not mean that it's necessarily available as cash. Because the retained earnings consists of, if you go back to that balance sheet where we have assets equals liabilities plus owner's equity, and retained earnings is a part of owner's equity. If you've got a lot of capital assets, then your retained earnings aren't available as cash, because you've taken that $10,000 per year and been investing it in an asset that is not cash. So you can see here we have two balance sheets. We have one that is 2019 and we have a 2020 balance sheet. So in here is just the bottom line from the income statement. It's our net income that was there. So we had some revenue, some expenses, and here's our net income. So the retained earnings at the end of 2019, so the earnings retained in the business to that date was 10,000. We had a new profit of 5,000, new net income. Again, now earnings that are retained in the business. And so at the end of 2020, we have 15,000 of earnings retained in the business. If it is a company that's growing, it particularly growing and in reinvesting in assets, that retained earnings number would continue to grow each year, because the company makes some money, it takes it and invests it in some more assets. Okay, so now let's just take a look at the profit and loss statement. So just going to go through this a little bit more than just the depreciation. We have revenue, we have cost of goods sold. So revenue, just to refresh or reiterate some of the balance sheet concepts, that unearned revenue, that money that was a deposit on some work to be done, would not be included in this revenue here. If we received it, if I'm looking at this as being a year, so this is the whole year, and we had received a $10,000 deposit for work that's going to be done for next year, it would not be showing here. On the flip side, if we had unearned revenue in last year's balance sheet, because we had received a deposit just before year end for that work, we would have now acknowledged it as revenue in this amount. Again, all of the timing. And so it's important to understand the breakdown of what made up this revenue, particularly with all those accruals at year end. Cost of goods sold, we'd have to be careful with the year-end adjustments, that if we bought inventory right at the end of the year, that we didn't accidentally expense it in cost of goods sold, because it's actually an asset. So if we say bought $10,000 worth of inventory on December 28th and included it in cost of goods sold here, we would be understating our gross profit. We would be increasing our expenses in an invalid way, let's call it. You'd want, so this, again, this is why we move things to inventory until we sell it. Now, these non-cash expenses, depreciation and amortization, we may have bought that dump truck, that $50,000 dump truck that we were expensing 10,000 per year. We may have bought it 3 years ago. The cash went out 3 years ago to pay it, or maybe we took a loan. But we're just acknowledging the actual use of that truck as time goes on, again, to match it better to our revenue, so we don't have big swings in our bottom line that are what I'll say false, because we actually need that dump truck to do the work, and we need to take into the expenses the use of that truck each year. Amortization could be for a number of other things. It could be for those trademarks. It could be for a client list that you bought. Might be amortization on other assets as well. So now let's talk about non-operating activities. This is particularly important when we're trying to understand the cash flow of business. Non-operating activities are things that are, I will call them, they're a different decision other than doing operating of the business. This is important to unwind for a lot of small business owners, because we sometimes think of financing decisions or some of the as really being integrated in the business operating activities, but they're actually a separate decision. Okay, so interest expense is an expense incurred because of how we've decided to finance the business. We decided we would take a loan from a bank instead of getting another equity interest partner that we would pay dividends to. So it's a financing decision. Or we decided we would pay interest on a loan rather than wait a year to acquire a piece of equipment when we could have earned some cash in the business. So there's this other revenue and gains could be and I'm looking here, I think that's actually interest revenue as well. It says interest expense, but the way things are looking here, that's maybe interest revenue. Same thing though. The company could have extra cash on hand, and instead of investing it in operating assets, they've decided to invest. So they could be invested in some stock market shares. They could be invested in some, they may have given a loan to somebody and receiving interest on it. Same with this other revenue and gains. These are things that are investing or financing decisions that are independent of the operating activities of the business. We might have a discontinued operation. So let's say a small business owner, they own, say, 3 locations, three restaurant locations, and decided to shut one of those locations down. And in that, there was some extra cost associated with doing that. There was severance to the employees. There was maybe a lease break fee and all of these types of expenses to shut it down. We would actually remove it from all these other categories, because this isn't it isn't going to be an ongoing cost of the business, and we would move it down into the discontinued operation. And income taxes are not an operating activity. They are something that is determined independent, generally as a percentage of the income of the business, and it would be the tax income. So there might be some accruals that a business makes that aren't allowed for tax, and a few adjusting entries to determine taxable income. And so that is something we have to know what that number is, so we can plan for it and incorporate it in our budgeting and planning. But it's something that we don't really control, other than the way how we might control how our revenue comes in. Okay, earnings per share. So this is particularly important for private companies that have, several investors, maybe a private company that offers an employee stock option plan, or even for your own little business. You could be figuring out what your earnings per share was and compare it to some publicly listed companies. It is a number that's more relevant in the public company industry, because the more earnings per share, the more as a shareholder you are going to have possibly as a dividend. Okay. It's not to be confused with dividends, because dividends are a separate decision by the board of directors to return some of that retained earnings, the earnings retained in the business, to return it to the investors as an income, or to keep it in the business. So in this case, the original investment was 50,000. You have 5,000 shares that were issued, and so it was $10 per share that was originally paid for those shares. That's just your original investment. This is just your what I'll call paid up capital from a tax perspective, or your adjusted cost base. So now we want to figure out in the year, what was my earnings per share? So we had 5,000 shares that were issued. We have 32,000 of earnings. And I don't want to complicate it too much, but you can have earnings before interest and taxes and depreciation. So EBITDA, or you can have it as the net earnings per share, which is after taxes and everything. And there are different terms for each one of those, but let's just call this flat out net income after tax, after depreciation, after all of that. So 32,000 divided by 5,000 shares, we get $6.40 per share. That's what the company earned in the year. Usually the company has to retain some of those earnings in the retained earnings category and not be able to distribute those earnings as a dividend. As a business owner, you can take dividends, or you can just pay yourself more salary. If you pay yourself more salary, this earnings number obviously is down a lot. And if you really want to figure out your earnings per share, you might do an add back of your salary that you took to figure out what the company's really making. And you have to be careful with what I just said, because you want to make sure you keep a salary in that's reasonable for keeping the business going. But if you've taken an extra bit as a bonus, maybe you take that piece out, and that would be really what the earnings per share was before you took that bonus. It's a way that business owners will evaluate their and compare their business to others. And I think that is just the end of the slides. And so there's a few things in the resources that were sent out to you. I understand there was a glossary of terms. There was an implementation checklist. I'm just going to pull that up. Hopefully you can all see that fine. So this is in there. So I'm going to go back to the first comment I said. A lot of my business owners don't understand the impact that the balance sheet has on the income statement and how important it is to get that balance sheet right. So we want to make sure that we've always reviewed the balance sheet. We understood all of the accruals that are on there. My prepaid expense, oh yeah, that's the insurance that I paid for in June, but I didn't use up. And so it's going to get used up in the next year. That we know that the raw materials, the work in progress, or any other inventory, we say it's consistent. I would say it's actually accurate. You've done an inventory count. You've valued the inventory according to the current cost, or the last cost you paid, let's say, for and that you've understood, particularly if you're working with your external accountant, that you've understood, you've asked questions, what is in that accrued liabilities account? if they haven't told you already in your year-end review. You want to make sure that you review your monthly profit and loss. Get an understanding of all of the reasons why you might have swings in the bottom line. Is it because we didn't record an accrual properly? You know, I bought a $50,000 dump truck and I just expensed it instead of, you know, putting it in fixed assets. These are mistakes that happen regularly, and that we just want to make sure that you're actually reviewing those statements and asking logical questions about that. So the other piece that is in there as a recommended source is this business development bank. And if any of you are not yet familiar with a lot of the resources that are available on the Business Development of Canada website, I would encourage you to get familiar with them, get on their regular email list, because of all of the organizations out there, they are funded by government actually to help all of the small business owners and give a lot of education materials. So I'm just popping up right now this one recommended website. This is the income statement, you know, tells you a lot about how you determine your profitability. And this is the other one that was referenced there, is properly measuring your profit using these 4 key steps. And I like the first one, take ownership of your numbers. It doesn't just belong in your accountant's hands. Make sure you get your accountant to give you some education. We know a lot, and we can definitely share a lot of information to help you. Make sure that you actually check your financial statements for mistakes. Make sure you're reviewing it with your accountant in detail and that you understand it. So these are all good, useful resources, and the BDC has tons of more. So I'm just going to check the questions. So I am getting some questions. Linda would be able to answer this, I think. Questions about, I didn't receive the PowerPoint presentation, and is it available to print on this webinar? Where can we find the handouts? You know, I might be able to populate them on the chat if you haven't gotten them already.
And yes, I didn't receive those, Vanessa, by email. So if you want to send that stuff to me, I'll be following up with everyone, sending out the PowerPoint, sending out any documents, sending anything out with a link that you can all access, along with a request for you to complete a survey with us. So anyone who's attended today's session will get that information. If you forward it to me, Vanessa, I can email it out to all the attendees for today's session and make that easy for everyone. In terms of BDC links, I'm going to put a few BDC links in the chat for everyone.
Sure. Linda, is it okay if I just attach these in the chat for anybody who wants to take them now, and then we'll still send them out? Is that okay?
Yeah, that is perfectly fine if they're able to grab it from chat.
Yeah, sure. I'm sorry. I thought that because they're standard by CPA Canada, I thought that they would have gone out.
So for those of you interested in additional course or blogs or information, one of the great resources of the world for Canadian entrepreneurs and all of the goodies of the world reside on the BDC website. For those of you not familiar with the BDC, it's the Business Development Bank of Canada. It is your crown corporation, your taxpayer dollars at work. It is the bank for entrepreneurs. And if you go into the articles and tools section of their website, when you land on it, they have articles, tools, free courses, ratios, downloads, anything you ever wanted to know about anything financial, entrepreneurial, or otherwise on the BDC website from there. So I'm going to get the BDC. It's bdc.ca. You can all sort of land on that. So we'll put a few things in the chat for everyone. And What else can we get in? For those of you who are not into fully advanced financial statements, say you're starting a business or you just need a little start support, if you visit the Business Link website and you go to our downloadable guides section, we have a whole section on finance. In there, we have short videos. We have a number of tools and resources. So I'm going to start to stick some of those in the chat as well, while Vanessa places a few documents into there as well.
Yeah, I've already posted them, so everybody should be
Awesome.
able to see them. I see a question there. Are you taking on new clients? I right now I actually am. My more recent career history is that I sold an accounting practice I previously built. And I went to university for a couple of years, which just happened to coincide with COVID. It was a good time to be studying. And so I was studying sustainability and real estate specialty and a lot of charity work. I was doing some specific research specifically on the charitable sector. And then found I just needed to come back and help all the small business owners who got hit in COVID, because my heart has always been with the small business. And so if anybody did want to connect with me, I have the website would be vabrown.ca, and you would find me on there, and you'd find a little bit about me, and you can also request my monthly newsletter.
This is really great, Vanessa. Thank you. We often cover at Business Link, we often cover startup and basics and fundamentals, but it's a real important challenge to all entrepreneurs and for everyone who is on here today to get to the next stage, which is a little more advanced, a little more understanding of how to strategize more effectively with your financials. And that's what learning all of these concepts and understanding the balance sheet and understanding depreciation and amortization a little better. It helps you go from basic understanding and keeping up with your business to forward thinking and planning and strategizing to take your business to the next level and leverage resources like Vanessa, like your CPAs, to really manage and strategize your next steps. A lot of business owners don't do that enough, I think, with their professional advisors, which is sit down and work out how do we work strategy for the next 1, 3, and 5 years, and what do we need to plan for equipment and tools. And these are the fundamental dashboarding pieces that show you how to plan those things from a financial standpoint.
I will also mention I have two businesses actually. I have my Prof Corp where I do the usual tax year end work that a lot of business owners would do, but I also have the small enterprise CFO, which is for fractional controllership or fractional CFO services. It is more at that strategy level. It is about key performance indicators. It's about, I want to grow my business and, help me understand my numbers, so that, because growth is a scary place. Growth is a place that it's great. We want to be there, but it requires capital before you've actually received the revenue. And so the cash flow needs to be managed very well in growth. So
I couldn't agree with you more. I found growth in my company much more challenging and harder to deal with than startup. I just have to say startup was a breeze compared to trying to grow. I felt always overwhelmed, always broke, always scared. It was a scary place to grow and then take on additional. I took on a lot of debt to grow, a huge amount of debt that was so outside my realm of comprehension that it is, even to this day, as I'm repaying that and I look at that coming out of the bank right now, I'm like, it is a scary place to be, but certainly it gets you to the next level quickly, and you start to understand quickly. You can't just stay where you are with your understanding of financials. You've got to get good at this stuff to work with your accountant.
Yeah, Linda, you're right. I grew my practice originally from 5 clients to 125 in the first year, and then started to bring on staff. And bringing on staff is a scary place because first of all, I had to have a sort of 1.5 people time worth of work so that I could fill their schedule, have half my time devoted to doing files, the other half to going out and negotiating new contracts and doing marketing and things like that. Then I did a leasehold improvement. And, you know, there's all of these things that come along as you're growing the business, and growth is wonderful. We all want to be in growth, but it has to be managed well, and managed well, it can go just fine. So anyway, thank you everybody for being here. I really appreciate it. And yes, see an email from Lise. We will be sending out all of the webinar documents by email as well. Okay.
Thank you very much. Appreciate your time. What I'm going to do is I'm going to stop the recording, everyone. You're welcome to leave, and I will just auto end this in about 30 seconds. So have a wonderful lunch, everyone. Take care.